If you do not think everything is awesome again, our next guest has a way to seek safety. Let's bring in Michael Kantrowitz, Chief Investment Strategist at Cornerstone Macro. Michael, great to have you back.
Good to be back.
You've come here and talked about the Trump trade, which remind us what that stands for.
Sure. Treasuries, Reits, utilities, momentum, and precious metals.
Okay, so this is a defensive sort of basket of stocks, and this has done very well lately in the market environment.
Yeah, I think today is probably the first down day in a while.
But do you keep this trade on?
Absolutely.
Okay.
Yes.
So what do you see ahead that makes you want to stay defensive?
Sure. We think that there's three reasons you want to remain defensive. Number one is we think credit spreads are going to start, or I should say continue to widening out. That began in 2018, kind of a soft rise in credit spreads. We had a big pop at the end of last year. They came back in, and now they're starting to move higher because earnings in the economy have continued to lose momentum. That's the first one. Secondly, we think leading indicators like manufacturing PMIs are going to continue to remain under pressure. We just now broke the ISM manufacturing index, finally broke below 50, which has happened in every single Fed tightening cycle. So, and then the third thing is we think recession risks are going to continue rising, and that really comes back to jobs. And so where we are in this cycle now, we've seen leading indicators slow, we've seen profits slow. The question is, are things going to continue to slow enough to see things like weakening employment data, so rising unemployment claims? And that, I think, is ultimately going to make or break this market in the next 6 months. And there's a lot we're seeing that warrants caution in paying attention to that.
So I'm curious on the REITs part of it, because that seems to me to be the most economically sensitive part of it. So if we're looking at a slowing economy, I would think REITs, yes, I get it because they have yield, but wouldn't you be concerned about their earnings?
Sure. Within REITs, you don't. It's not the hotel REITs that you want to own because the prices get reset there every night. It's the longer duration REITs, healthcare, industrial REITs, which have done really well and are the reason that REITs trade like bonds. So you want to stay away from the hotel REITs, but as a sector, as a group, they still trade like bonds, and we think yields are still going to move lower ahead. But yeah, there is economic sensitivity there. Utilities is kind of a pure bond play.
So the TUP, the Treasuries, utilities, and the precious metals of that. I mean, inherently, I would imagine there's some negative bias to the S&P 500. For this trade to continue to work, does the broader market or the S&P specifically have to trade lower?
No, it's worked really well with the S&P moving sideways. In the last 18 months, the S&P has essentially gone nowhere, and you've made a huge amount of gains in tech, discretionary, REITs, and utilities. I think those are the only four sectors that are actually up, going back to January of 2018. And so we are bearish on equities, but I wouldn't be shorting the S&P. I'd be shorting smaller cap, cyclical, the Russell 2000 Value Index, or small caps or the mid cap value. S&P is the last thing you want to short because it's got the most utilities, staples, healthcare, and REITs, which it'll be the last one to go.
All right, Michael, great to see you. Thank you, Michael Kantrowitz of
thanks.
Cornerstone Macro.
Great looking beard, by the way. No, talk to Steve. I just wanted to point that out. It's good. Solid.
Yeah. I didn't know
I just brought it out. I wanted to bring it up. That's all. Look at that. It's a good-looking beard.
Steve, what do you want?
So XLUs, the utilities are up 20% year to date. I think you could stay there. I think on a head fake day like today. But I think gold's really fascinating. GDX, the gold miners, 45% year to date. I'd stay in that trade. I think it's got a lot more room to the upside.
I'd agree with you. As a matter of fact, I'm still long GDX, which I added to just the other day. And even though we had this pullback today in metals, they've been sprinting to the upside, absolutely on fire. And he mentioned some of the technology names too when you talk about momentum. And I think you look at some of those names, when you still have the fundamental story there, Mel, and what we've heard in this last earnings cycle was still pretty strong in majority of those names, I think you can stick with that along with the metals right now, especially silver.
All right, we've got a news alert on Apple. Let's get to Josh Lipton in San Francisco with the details. Josh.
Yeah, Melissa, some Apple news here. Apple does plan to offer here $7 billion worth of bonds. We knew they had filed it. We didn't know how much, though. Now we do. It looks like ranging in maturity between 2022 and 2049. First offering, by the way, since 2017. Plans to use the proceeds, it looks like, for general corporate purposes, share buybacks, payment of dividends, funding for working capital and acquisitions. And again, the headline here, Apple will offer $7 billion worth of bonds. Melissa, back to you.
All right. Thank you very much, Josh Lipton. That's actually the exact amount that they last borrowed from the bond market back in 2017. This week has been a monster week for issuance. Tuesday alone was a record issuance led by Disney.
Because everybody thinks yields are going lower, right? That is the trade here. That's what everybody's in. Ultimately, what concerns me is, how much capacity is there out there for all this debt issuance? Now, remember, we also have U.S. Treasury debt issuance coming out. So far, they've been able to get up. Good for Apple. This is exactly what they should be doing at this point in time. There will be a day, and I think we might even have somebody coming up who could tell us when that day is coming, that these bond deals can't get done. But until that time is, Apple should keep doing it.
They've already got $200 billion
that's
in
what I was
cash
gonna
and
ask.
cash equivalents.
What's this? I don't need. I mean, I'm sure
A rainy day.
I like good rainy day. Sometimes you watch a good movie on the Netflix. I mean, maybe that's a good point. $7 billion for a rainy day. It's cheap money. It makes a lot of sense. Good point by you. I don't know why they're doing it.
And people want to give money to companies that are successful, the companies that can outperform, and you don't know what they're going to do, but it's cheap.
Right?
It's cheap. It's a low risk. It's cheap. Continue that machine keeps going. They're getting paid to do what they do, and that's make money.